Hello, everybody, and welcome to the show today. Today, we're going to be diving in and talking about how you can get loans based only on the revenue that you have. So a lot of what we're going to be talking about today is how to get financing that's not based on personal credit. Personal credit doesn't matter. Collateral doesn't matter. A lot of these other things that lenders look at aren't looked at. All they're really looking at is just you consistently earning revenue and responsibly managing your bank statements. Now, if you're attending live, we had another one scheduled for today. This was actually scheduled a couple weeks back for YouTube Live. But I was actually out of town and missed this. So here we are. We're going to be diving into this topic today. And the other one that we had scheduled for today about business credit reports, we will be diving into in the weeks to come. So those that don't know me, my name is Ty Crandall. I'm actually the CEO at CreditSuite. At CreditSuite, this is what we do. We help businesses get capital by helping you become more lendable, by accessing business credit and also accessing all different kinds of loans and credit lines. We're one of the only sources out there that works with all legitimate funding sources in one place, which is why we know so much about this topic of how many types of revenue financing there is available for you today. Now, if you go to creditsuite.com/get funding at any time, you can go there, fill out a few questions, and find out all the money that you can qualify for your business. So feel free to go check that out. That's something I think that you will really enjoy. Okay, so let's dive in. So let's talk a little bit more. What is revenue line or loan? Well, a revenue loan or revenue-based loan is an alternative type of loan. Okay, so unlike a bank loan, it doesn't require collateral or significant assets. And unlike angel investing or venture capital, money isn't handed over in exchange for a piece of the business. It's not handed over in exchange for equity in the business. Instead, the loan or credit line is basically paid back as a percentage of your incoming revenue. Okay, so what this really happens with revenue lending is this. First of all, it's not really a loan. What you're ultimately doing is you're selling future revenue at a discount. So think of it like this. What these lenders have found is that they can look at how you manage your money, get a pretty good idea over the last 3 or 6 months, how much money, how you manage your bank account, how much is going in, how much is going out, whether that's stagnant, whether it's increasing, decreasing, etc. And then what they do is they type all this into their computer systems that come up with calculations of how likely you are to pay, whether you should be approved or not, the rates, the terms, all these things. So what they're basically doing is just looking at how you manage your previous revenue, how you handle your business when it comes to your business banking. And then what they're doing is in projecting what you will do, and you're selling future revenue to them as a discount. Again, the nice thing here is that you don't have to give up equity in your business. You don't have to have collateral. You don't have to have credit and these other things that are needed for a lot of other kind of financing. So the lender, or investors or whoever it may be, takes an equity warrant, okay, which means they have a fixed price if they want to buy stock in the company until an expiration date. The business owner does not need to back the loan with their own personal assets, although in almost all cases, you are asked for a personal guarantee. There are some sources out here that we work with that you can do these without a personal guarantee, but even though assets aren't needed, most of the time they're going to need a personal guarantee. And no valuation is done on the business's assets. Either all that's really needed is you have to be generating revenue and you have to have good margins, or basically it's not even margins. They're not looking at your tax returns. What they're looking at is positive cash flow. They want to see more money going basically into your business bank account than's going out. Okay, that's ultimately what we're really looking for here. So one way to get revenue-based financing is via crowdfunding platforms. Okay, interest is paid off at a tax deduction if you're paying that, and usually they charge a fee versus actual interest, which is about 5%. Okay, and again, with this, it doesn't work for every stage of a business, but again, it's pretty good for a company that's newer or a few years in business. With this, you're basically able to come in and get money from a crowd of people to actually be able to come in and qualify. Now, I don't know if this isn't necessarily revenue-based financing, but I wanted to throw that in there because crowdfunding is similar, that if you're especially producing and showing a product can sell, then it's definitely a great place to go. Now, with this, you can get as much as, $1 million within weeks. So there's a lot of different options when you're really talking about that. Now, another one of our favorites is Fundbox. Okay, this is one of the best financing that's out there. You can actually get this at creditsuite.com/Fundbox. We have a special link for you there. And with this gets you one of the easiest and fastest to qualify and fastest credit lines that I've ever seen. Okay, so now with this, you now have up to about 6 months to pay. Okay, and this is a credit line. You're getting $1,000 to $100,000 $30,000. Usually they're going to want 6 months in business, maybe 25,000 in annual revenue. You need to have a business checking account. Now, this fluctuates. We've seen people get approved with as little as 3 to 6 months in business, and the revenue, we see people with as little as 5 to 10,000 now getting approved. But you have to keep in mind, if you have smaller amount of revenue, your credit line is going to be smaller. So this is one of the best products I've seen out there for credit lines. One of my friends approached me the other day in credit repair and said, I want a revenue lending loan. I said, that's probably more expensive money than you need. Let me try this. And we were able to get him a $30,000 credit line with an interest rate less than 5%. And there's no minimum credit score requirements. As a matter of fact, a lot of times the initial financing, they may not even pull your personal credit. And again, you can go to creditsuite.com/Fundbox to get that. Now, SmartBiz. So let's talk about SBA loans. 30,000 to 5 million available. Really good rates. They're averaging about 8%. We are doing a ton of these right now. Okay, we're getting ready to close on a $320,000 SBA. We just had a client get a $350,000 SBA loan the other day. But these are nice because you're getting 10 to 25-year terms. So let me give you an example. This $325,000 loan we were looking at, the person was trying to get another kind of loan, a revenue lending loan, and they basically had exactly the same payment on a $75,000 revenue loan as they did on a $320,000 SBA loan. And the reason it's possible isn't because where everybody gets stuck right here. Everybody gets stuck on interest rates. What's my interest rate? What's my interest rate? Stop thinking about interest rates. Interest rates are based on your risk anyways, and they're 100% tax deductible. If you want low payments on money you borrow, this is the main thing you care about, the term. The longer the term, the lower the payments. So what makes SBA loans so nice is that you're getting these long terms. When you have 10, 25-year terms, you can keep your payments really low. Now, you're going to have pretty good credit, 2 years time in business at least, 50,000 in annual revenue, no outstanding tax liens, foreclosures, bankruptcies. If you have this stuff, you're just going to have to, if you were to get approved, which you typically won't, you'd have to pay it off. Okay, so we have one of our clients right now that actually has a judgment that doesn't even show on his credit, and the condition requirements that the judgment has to be paid off. The judgment has to be paid off to be able to close. So these require better credit, cash flow, tax returns, those kind of things. But again, this loan is primarily with SBA based on your ability to repay the loan. That's primarily what they're looking for is revenue. Now, BlueVine, $500,000 to $250,000 loans, okay, and lines pay back over a 6-month to 12-month term. So I like BlueVine. Fundbox is fantastic, but Fundbox only gives you terms up to 6 months. BlueVine gives you terms up to 12 months, right? So you've already learned what I just showed you is that you want to get the longest term. The longest term gives you lower payments. So in this case, these are credit lines though. And you have 12 months to pay it back. So it just gives you more time to keep that money outstanding. Approval in as little as 12 hours, rates as low as 4.8%, no collateral. You need 6 months time in business, average credit of 600 plus, 100,000 in annual revenue. Fundbox didn't have that requirement. BlueVine does. And you're going to have to provide a personal guarantee, as you will with a lot of these type of financing. OnDeck, 500,000 available in term loans, up to 100 grand available for lines of credit. So let's talk a little about this. So OnDeck is exactly what I described in the beginning. They are like thousands of other similar ones out there that basically are selling, or you're selling your future revenue to them at a discount. That's how that works. Okay, now they will do credit lines as well. So they'll now give you a loan and a credit line at the same time. But usually the credit line requires pretty good credit to get approved, we found. If you have good credit and a tax return, they'll do it. If not, those credit lines, you're probably not going to get if you have credit issues, but you're still able to get the loan. Terms of 6 months, okay, weekly automated payments, which means they would draw them right from your bank account. And here's a look at some of the requirements, but it was 75,000 annual revenue, 9 months time in business, personal guarantee. You're going to need that. No bankruptcy in the last 2 years, 600 FICO. You can go down off this. A lot of these lenders that do this kind of financing go down to a 500 FICO. Some of them have no minimum score requirement. So if you're less than 600, you could still probably apply with OnDeck. You just have a better chance if you have larger revenue, time in business to offset that. And again, a lot of other similar sources out there will go as little as 500 on the FICO or have no credit score requirements. Kabbage, really good program. Kabbage has $2,000 to $250,000 loans available, 6 to 12 month term, automatic payment withdrawal, no collateral or personal guarantee needed. Okay, I talk about personal guarantees a lot because I talk a lot about building business credit for your EIN that's not linked to your social, and that's credit you can get without the guarantee. But financing's hard to get without a guarantee. A lot of loans and credit lines are, unless you're providing substantial collateral. So in this case, it's pretty nice because you don't need that collateral or PG, and the lower FICOs are still okay, but interest rates are higher. And look, this is why I say don't worry about interest rates, because the bottom line is your interest rate's based on your risk. So if you don't like your rate, then fix your risk, right? Fix your credit, get collateral and improve how you do your banking. That's what they're looking at. I like high interest rates myself because to me, it's an indicator that the lender will help somebody with other challenges, like credit challenges, right? It used to be in the business space 10 years ago, you couldn't even think about getting a loan with a 500 or 500 FICO. Now you can, you're just going to pay a higher interest rate. And for me, that's the trade-off. You're higher risk, you pay the higher rate, but the good news is you can now get financing that you just weren't able to get before. 1 year time in business, $50,000 in annual revenue, must have a business checking or online payment platform. And again, about a 560 FICO. So I love Kabbage. I think they are very good. Now, I haven't seen them on the higher end of loans, but when it comes to getting 5 to 50,000, they are a phenomenal source that can really help you. And again, just so you know, we do work with all of these sources and then some. So if you're interested in finding all the money you can get, which is the better source for these type of programs, feel free to go to creditsuite.com/get funding. Takes less than a minute. You'll be able to figure that out. GSD Capital, okay, 200,000 to 1 million available, can fund to 6 times your monthly recurring revenue, okay? So whatever your monthly recurring revenue is, you can usually get about 6 times that amount. Offer in 7 days, funding in 30. Good for SaaS companies in Mountain West states only, and the requirements are detailed plans for growth, limited amount of existing debt, and clean cap table. So let me explain why this is so unique. Usually with revenue lending lenders like OnDeck, okay, I'll give you an example. What they're going to lend you is the equivalent of 1 month's worth of business. Typically, it's typically about 12% of your annual revenue. And if you think about your annual revenue and 12% of your annual revenue, what it really comes down to is you're getting about the equivalent of what you do in a month. What they're giving you here is 6 times the amount of what you typically get with those kind of sources. So completely different kind of lending that gets you 6 times what you get with other ones. But what they're really looking for is, for example, like SaaS companies. These are software companies, software as a service. And what's nice about SaaS companies is they deal a lot with recurring income. So what they're saying here is we like companies for this program that have recurring income, subscription revenue, revenue that's coming in month after month after month consistently. That's the kind of companies that they're really looking to work with. Synergistic Investments. Investors will work with business owners to determine the best type of loan based on revenue and company needs. Options include receivable financing and securities financing. Let's talk about both of these. Receivable financing is when customers owe you money, they're paying on terms. That's called account receivables. So if somebody pays me, well, let's talk about CreditSuite. If somebody enrolls with us and spends $3,000 for us to build business credit, get financing, build out their credibility, do everything, then they can pay payments of, let's say, $500 over 7 months. Well, that counts as account receivables, right? They owe us that money. So because that money is owed, then that counts as an account receivable, and that could be borrowed against. So whenever you see AR financing, account receivable financing, factoring, receivables financing, it all means exactly the same thing. It's exactly what I just described. Securities financing is when you're using stocks and bonds as collateral to get financing. Credit doesn't matter. Revenue doesn't really matter. You're using securities as collateral. Okay, interest rates as low as 8.99, no collateral or liens against working equipment or property, and no upfront costs. So good way to go. 10% fee based on total amount of business credit received. And again, no personal credit reporting. Funding is a little 20 days. No document or income verification, only based on stated income. So some cool things there. Hercules Capital, 1 million to 100 million. So this is for the ones that are looking for more money. Loans based on revenue only for SaaS companies. You're going to see this, right? Why do we like SaaS companies? If you're not a software as a service, you need to learn why people like SaaS companies. They like them because, as I mentioned, recurring income. What's nice about SaaS companies is if they are bringing in users that are paying them monthly, and so when they do so, they can pretty much accurately predict what they're going to do next month based on how many people they have paying the month prior and based on their current, dropout rates. If I know how many people I have in paying every month, how many I'm adding to that amount, how many are subtracting because of dropouts, then I have a very predictable way of knowing exactly what my income is. That's why they like SaaS companies. So what you want to learn from that, if you're not a software as a service company, is you need to know and learn that you want to have subscription revenue, recurring revenue. You don't want to sell a product where you just sell it and make all your money in one shot. What you want to do is set people up for membership programs, subscription programs where they're paying you over time. Matter of fact, what we try to do now with CreditSuite is if we sell a product, we try to now think about what other kind of product could help our customers that's a subscription product that goes with it. So for every product we have to sell, we try to have a subscription that goes with it. You should consider doing the same things because this radically increases the value of your business. Business does not need to be operating cash flow break even. Loan to value typically under 50% of the enterprise value of the business. Requirements: monthly recurring revenue of $500,000 per month. Demonstrate rapidly growing backlog of new customers. Strong customer revenue retention rates. Diversified customer base. Viable financing plan to achieve positive cash flow if you're not there. Okay, and backed by venture. Okay, this is backed by venture capitalists basically. Okay, Gud Capital. So commercial loan broker includes revenue loans. Amounts available range from $5,000 and up to over $20 million. And you don't need collateral, weekly or monthly payments. Lender will place a blanket lien on the company. Okay. Types of revenue-based financing: fintech, merchant cash advance, ACH advances, invoice factoring. Okay. Fintech loans are for companies in fintech. Merchant cash advances. These are just like the revenue loans are described, where you're selling your revenue for a discount, but they're only looking at credit card transactions with merchant cash advances. Okay. ACH cash advances. This also I call revenue lending. And this really has to do with, they look at all of your deposits in your bank account, not just your credit cards. And we already talked about factoring, right? Invoice financing. We found another name for it as well. That is that factoring we talked about before. Bank statements, credit card processing statements, financial statements, business license, 500 to 650 score. That's basically what you're going to need to be able to turn around and get approved. So let's talk about Decathlon Capital Partners. Okay, they're commercial loan broker, typical rates of 1 to 3%, revenue typically $3 million to $10 million, no equity warrants required, $500,000 to $5 million available with 2 to 5 year terms, no personal guarantee or stock pledges. Again, as I mentioned, there are some of these revenue sources that will do this without personal guarantees, and this is one of those sources. Okay, requirements: historical and pro forma financials. Okay, and if you don't know what this is, you're just not operating at that level yet, and that's okay. We talked about some options that work for you as startups or newer in business. We've talked about some options that really you can't even touch unless you're 1 million in revenue or more. So I wanted to kind of have a training across the spectrum. Okay, information about the company's history and future growth plans, data on the company's target market, product descriptions, insight into the management team as well. Okay, another bonus, DealStruck. So 50,000 to 250,000. We do a lot of business with these guys. They're really good funding source. Lines of credit up to 500,000, regular APR, fixed monthly payments, and again, to get approved, you need about 12,500 in monthly revenue. About 150,000 a year. Usually for most of these revenue lenders, they all want 10,000 a month in revenue. That's what typically a lot of these sources are looking for out there. Okay, another bonus, Next Step Capital Partners. Okay, no valuation needed, returns are capped, you can get funding pretty quick. If you've got a market proven product or service, substantial, a growth opportunity, profitable business, high gross margins, and about 250 to 500,000 in capital. Okay, so some other ones. Cypress Growth Capital is another great source you could check in with that has this kind of revenue financing. Crescendo Ventures is yet another one. Montlake Capital, okay, is another one that we found that works really well based on industry type business you're in. Intrex uses blockchain, Intrex.net. Blockchain's the new future in our world in financial services, and we love it because it's just going to simplify this lending process. It's going to make it so easy when this information's out there and they can track and make sure it's accurate. I can't tell you why blockchain's so important to what we do, because let me put it this way. Over 51% of loan applications are fraudulent. They're not even legitimate. So blockchain takes that fraud account in large point in future will take it out of their equation. And it's a really big deal because a lot of lenders turn down applications just because they're not sure if they're fraud or legitimate or not. And if we can use blockchain to fix that problem, then we will see approval rates on financing skyrocket. So I'm really excited to see anybody that's using that technology in our space. Now, equity crowdfunding is another source. Crowdfund.co helps with fintech, investor management, deal marketing, crowdfunding preparation. So that's another source that's definitely worth checking out as well. So remember, revenue-based financing financing is you're borrowing against future incoming funds. You're borrowing against future revenue in a lot of cases. Now, we talked about some options here where that's not exactly what it is because it's not revenue lending, but that's typically what revenue lending is. It doesn't depend on collateral. It doesn't depend on your credit. Often there's no credit requirements at all with a lot of it. And then when there are, they're as low as 500. And a personal guarantee is needed sometimes, sometimes it's not. It just depends on some other factors. We have some sources that will do this, but it is not common to get it without a guarantee unless you have some compensating factor. So firms offering revenue-based financing may offer other types of funding as well, but that's not really common. That's why we really do what we do here at CreditSuite. Revenue financing lenders usually offer similar products based on revenue, while credit-based financing that's only based on credit are usually that kind of financing is just available in different places. Some may also serve as venture capital firms, as we just saw. Others are brokers. We talked about them as well. So a lot of different options. So I talked about 10, but I think I went over like 15 to 17. As I always do, I have a tendency to under promise and over deliver. And I talked about a very wide array here. We talked about some like Fundbox, creditsuite.com/Fundbox, where you can get approved even with a few months in business and smaller amount of revenue. So we talked about other sources that you need $1 million in revenue or more to get approved. So hopefully you got a lot of information. If you did, well, please like this video real quick and subscribe. That tells YouTube that it makes sense and that I'm giving you good education and lets other people see it. I always appreciate that if you would like and subscribe. And then we notify you when we go live, which we pretty much do every Tuesday at 1 o'clock Eastern. And if you have any questions along the way, let us know. If you go to creditsuite.com/getfunding, what you do is you fill out a handful of questions and we cross-check your information against over 1,000 lenders at all these different loan programs. And then we get with you. We tell you all the funding you can get now. We develop a finance blueprint to graduate you up to SBA loans as well. So we'll help you through the entire process, and we don't charge you a dime of money for that. Okay, the lenders pay us back a referral fee, so it doesn't cost you any money to work with us. We even negotiate to get you better terms on the financing you do get. Or feel free to give us a ring, 877-600-2487, or send us an email, info@creditsuite.com. Thanks for liking and subscribing. I will see you next Tuesday at 1 o'clock Eastern. Have a great day.